Why do we not invest up north? Because it's colder in the north, so we don't like going up is one of the reasons. A bit of an explanation of why we like sticking down to the south. I personally believe it depends a lot around the strategy that you're doing. A lot of people that I know that do invest up north may have spent some time living up north, so their knowledge of that area is really key. So we like investing in areas where we have the knowledge. So every development in every location that we have, we know the area, we breathe the area, we've understood it. Obviously there's logistics like getting around sites, and so we can pretty much drive around all of our sites in one day, which is 5 sites. I can pretty much drive around all of our HMOs in one day, and that's definitely something that was considered. I thought this was an interesting one. A mentee asked me this question. I actually really enjoyed that mentee session, getting absolutely pillared to the post. Why do you do this? Why do you do that? And it's good to sometimes ask yourself the question. But the question is, why do we not invest up north? Because it's colder in the north, so we don't like going up is one of the reasons. I reckon so, because Christina's from Leeds, so she probably knows. I mean, I think that the red bit is all the way down to Banbury. As soon as you get to Banbury, that's the north for me. A bit of an explanation of why we like sticking down to the south for investing in it. Now, it's kind of like it was a buzzword and a buzz thing that you go to a property networking event and people are, I'm going up north for yield. A friend of mine, Ryan, he actually moved his whole family up to Darlington. And quite frankly, we haven't done that. So why haven't we done that? So I personally believe it depends a lot around the strategy that you're doing. A lot of people that I know that do invest up north may have spent some time living up north. So their knowledge of that area is really key. So we like investing in areas where we have the knowledge of what in there is. We like operating in areas where we have knowledge. So every development in every location that we have, we know the area, we breathe the area, we've understood it. So that's one key thing before we get into any of the strategy stuff. But I wanted to go into the strategy stuff to explain why. So development and build to sell is where you're buying a site, developing it and selling it, right? So the exit of that is gross development value. It's the pound per square foot that you're exiting at. If you are operating in Darlington, you're probably getting paid £200 a square foot to sell that site. If it costs you £250 a square foot to develop that, you're at a loss. So we develop to sell in our development company. Therefore, we like getting paid for that development. Marlow, we're hitting like 700 a square foot. Colney Hatch Lane will hopefully hit 800-900 a square foot. Abingdon will hit 500 a square foot. Tame will hit 500 a square foot. So these areas warrant us to build out for the build costs that we have. Yes, it is slightly more expensive in and out of London to develop, but it's not relative. It's not costing you double. It might be costing you incrementally more, but the values are better. So that's one reason. Build to rent. Now, build to rent down south is more difficult because the capital values are higher and the rent is not discrepancy and relative the same. So build to rent actually works way better in high yielding, more northern locations. And when I say north, Manchester has seen huge growth over the years. So that is a bit of an anomaly. Birmingham equally too. Some other areas in the north are seeing some really good growth, like Liverpool. Would recommend that if you are looking at developing up north, build to rent strategy might be something to look at. So what that actually is you're buying a plot of land or building a site out, renting it all out so you get a gross rent. You may then have operational cost to manage that. So whether you give it to a management company or manage it in-house, and then you're selling the income like our social housing portfolio. And that might work. Build to rent, whether it's social housing, PRS, student, whatever it may be, might work up north. HMOs, I kind of believe they kind of work everywhere. I've seen people build very successful HMO portfolios in London. We build them in Oxfordshire. I've seen people build them up north. So that's similar. It's probably easier to build a higher cash flowing portfolio up north, but then you don't necessarily get the capital appreciation in potentially the south. Service accommodation, similar. It works everywhere. I see service accommodation is basically a hotel, but your stock is spread rather than all in one building. Kind of works everywhere in the UK. So I would recommend that probably could work nationally too.
If this video resonates with you and you can take away just one thing into your business which will make it better, then creating this video has been a success. If you do get value and are getting value, click subscribe down below. That would mean so much. Back to the video.
Actually was on the Josh Keegan's Ultimate FD podcast this week, talking to somebody that's built a service accommodation business. And I found interesting, he was sort of saying service accommodation there's so much supply now of people going into that space that he stays well clear of the sort of 1 and 2 bedroom type properties. His biggest money earners and most profitable type lets are large family houses, basically houses that can cater for 8, 10, 12 people that are looking for group bookings that are more difficult to get into. You got a lot of rent to SA type people that want to get into it and see it as a great way of making cash flow, which it can be very time consuming and operationally intensive. But because of the entry point and the lack of funds behind them, they can only generally, or they think they have to get into 1 and 2 bedroom flats because that's like the cheapest route into it. Whereas he's saying there's way more profit and there's way more less hassle and lower occupancy rates, but higher night rates, there's less people operating in that space. So if you can secure and find those types of opportunities, you're weeding out a lot of the competition with that type of stock, as opposed to just the typical 1 and 2 bedroom flat, which is extremely saturated.
I don't know how people run service accommodation businesses. It's kind of like notification galore. On to flips. Flips are obviously easier, like developments, to make them work in the south, but more difficult in the north because your budget against exit is different. But I do believe flips work in both locations. Trading works anywhere. Trading is basically taking something medium, low or high and getting rid of it for higher values. So I would definitely say that trading works in all locations. And then I would also say planning is also a strategy that can work anywhere. The reason being, planning is kind of like a multiplier. You can spend 20k and get 80 return in value add. So there's a much more of a multiplier. Therefore, the value exchange is fair. I hope that's been useful, and that's why we stick south. Obviously, there's logistics like getting around sites and stuff. Like we can pretty much drive around all of our sites in one day, which is 5 sites. I can pretty much drive around all of our HMOs in one day, not both the same days, but we like that sort of locality that we're developing in, and that's definitely something that was considered. Tom has asked or said, I wouldn't want to spend 100k converting a HMO on a house I paid 100k for. It doesn't feel right. Completely agree, and that's actually why we stay in the south. My friend Ryan Beaumont up north does spend more than sometimes the house is worth, but he's doing investment valuations. That's what he wants to do, and that's what he can do. So actually, the HMO portfolios that we've been building in the south, when we finish the conversion, we can sell it for more than we've spent on bricks and mortar valuation. We haven't done one HMO that could not be sold for more than what we paid and spent on it, and that's how we ingrain equity in our portfolio, because most of them are bricks and mortar valuations anyway. So completely agree with that.
If you got value from this video, make sure you click the subscribe button down below and ring the notification bell, because we release one video at least every week, so you'll be the first to get notified. See you on the next one.